Hello there traders, in this video I'm going to show you how to use fair value gaps. You are going to understand how to use the correct fair value gaps in the market so that you can at least improve into your trading. So for basic purposes, a fair value gap in a bearish trend is just a space between this wick, the first candlestick here, and then the third candlestick right here. This is the fair value gap. The space in between, this is what we call a fair value gap here. This is the space in between. So what I mean is that this one here, that means we will be looking for the market to come to this area and then to shoot lower. The same thing applies on a bullish trend. If we have a space in between the first and the third candlestick, we will have a fair value gap. So that means right now from here, you will be looking for the market to come to this area and then close it and move to the upside. But there will be a lot of fair value gaps in the market. So you have to understand that if we have a lot of fair value gaps in the market, it will make our trading decisions very difficult. Okay, so right now I want to show you how you can at least understand which fair value gap to use in the market. So sometimes if we have a higher high here and then we have another higher high right there. But then when the market comes to this higher low, let's say we have a demand zone right here. But if we don't have a fair value gap right here, that means the market is likely to break this previous low here and then trade into this one here and then move to the upside. And also guys, when you see a demand zone right here, you have to always or at least confirm your demand zone with at least a bullish momentum right here. But if there's no bullish momentum right there, that means the market is likely to break the next demand zone here. So let's say right now we have a bearish candlestick like this on the demand zone. So that means price has already voided this demand zone here. So that means we have to avoid this kind of trade. And sometimes we can have another imbalance here. An imbalance is just a fair value gap, guys. Here, if we have an imbalance here, we have to consider the price section that is going to be printed here. And also what I like to do is that if we have an imbalance right here and then we have a low, I will wait for the market to come at least to break this low before the market can move to the upside. The same thing applies on the bearish side point of view. On a bearish side, we will be looking for the market to at least trade above this previous internal high and then move around this area. But it's not always the case that the market is likely to break the internal high. Sometimes the market can even drop from here or retest the supply zone from here and drop lower. But only price action will tell us the story when price reaches this key levels. So based on this analysis, that means you'll be looking to enter the market right here, or maybe you will be looking to enter the market right here. But there will always be a price action reaction here. You have to find a structure in the lower time frame. Maybe let's say if you are in the daily time frame, that means you will be moving to at least the 1 hour and the 30 minutes time frame, so that you can at least find an entry around the retracements here. Like this, you'll be looking to enter the market at least around these areas here, maybe making a take profit to this previous new low here. This will be your target. But you have to always find price action so that at least you have a confirmation that the market is likely to move to the downside. If you don't have a confirmation, the market is likely to bully you. So from here, you can say that you have an imbalance. You're waiting for the market to at least fill this imbalance, come to the supply zone, give you a bearish candlestick, and then you will move on to the lower time frame to find entries. But if you are doing something like that, that means the trade you're going to hold will be a huge one, because you're going to hold it for a long period of time. Because I've seen a lot of people enter the market right here and then they will just close their trade around this area and then they will miss a lot of these pips here. So moving forward, let me show you some couple of more examples that the market might do. Most of the time you'll see that if you have a imbalance here, you will see that the market will start to consolidate and then suddenly we might even have a sharp move to the downside to close this imbalance, and then price will shoot to the upside. So your focus should be on this area. If you put your buy limit order here, the market might even break and then move to the upside. So that means you'll be in a trade that is a loss. And because we can see that we have this lows here, lows here, lows here, price can still move to the upside without even filling up this imbalance here if the market is very aggressive. But if you understand higher time frame, and if you have a trading strategy from the higher time frame, that means in the lower time frame, you won't even be surprised if this thing happens like that. Another thing is that I would like to at least wait for the market to at least break some of the previous highs here, and most of the time you'll see that price will consolidate around this area and then move to the upside, and then it will drop lower. I have made a confirmation video before this one. If you watch that video, you will understand how to use candlestick patterns to enter the market in the lower time frame. So this video is not based on those entries basically. And if you look closely, this area here will be where most of the traders will be looking to enter short, because this is a strong resistance level. So price will eventually shoot lower a little bit, and then it will move to the upside. And yes, sometimes fair value gaps don't get filled, because if you check closely in the higher time frame, you'll see that sometimes you won't even have fair value gaps. So in the lower time frame, because price is zoomed in, you'll have those fair value gaps that won't be filled. So you just have to understand that the market is likely to come from here or retest here, or even break this previous high before it can move to the downside. But if you look at a couple of more examples, guys, you will understand this very clearly, because this is just a illustration. The market won't even move like this. This is just a pattern, but in the real market chart, there will be a lot of difficulties that you need to understand. So let's look at this one here. We have a break of market structure to the upside, meaning we can see that price broke to the upside, and then price is also at the demand zone, and this is also a bullish engulfing candlestick. But we have another imbalance below and also a demand zone. So that means price is likely to move to the upside from here, or retest this one and move to the upside. So if you have watched the previous video, you will understand how you can take this trade, and you can also even miss it. So let's say right now you have entered the trade, let's say on the close of this candlestick here, and then you put your target to this high, and then you wait for the market to play out, but then suddenly you are stopped out. I know most of you guys will give up because you already hit your stop loss. So right now that means you'll be waiting for the market to fill this imbalance below, and then try to enter the market again. Let's see how the market behaves, and you can clearly see that price did not touch this demand zone yet. So that means you have to wait once more, and then we have a touch of this demand zone. Most of you who are not patient enough will just enter because price already touched the imbalance, but there is a demand zone below. You have to understand that. So that means that right now you have lost this trade here with around 11 pips. So right now, what we can do here is to wait for the market to make a confirmation candlestick here, because we are on the demand zone, and we also have a demand zone. So that means this structure will look something like this. This is the structure. It looks something like this. Yes, something like this. This one here, this is the internal high here. This one here is just very small. I hope you understand it in that way. So then from here we can wait for a bullish candlestick close, and also it will be perfect if the bullish candlestick close is a rejection candlestick, because we also have a bearish candlestick here. This is a bearish engulfing candlestick, and then we wait for a rejection candlestick, and then we enter the market. Okay, we can see that we have a rejection candlestick right here, which is also another thing, a bullish engulfing candlestick. So that means right now you can still enter the market around here, put your stop loss around this area, and then you wait for the market to do whatever it wants to do. And there are a lot of strategies, guys, to manage trades. So if you don't know how to manage trades, please comment below. I'll just make a PDF so that you can at least know how to manage a trade after being in the market, because sometimes you get in too early and then you close in early, while the market has a potential to move and give you a lot of profit that you could have recovered most of your losses. So this was the first example, guys. Let's move on to the next one. Here we can see that we have a resistance here, and then we have the support below, and then we also have an imbalance. So from here, that means your analysis, if you are using only imbalance and demand zones, that means you'll be waiting for the market to come to this area and then give you an entry and then move to the upside. But the market can still move to the upside, come to this area, give you a bullish candlestick and still drop lower. It can still happen. You have to analyze the market in two different ways. Know your possibilities and chances of losing into this market. So from here, that means we have to wait for the market to do something, but someone will try to sell around this area for the market to move to the downside to fill in this fair value gap. But just look at what happened. The market is just playing around in this area. So if you have entered short, that means you'll be stopped out in this trade. But there are a lot of entries in the market right here. This is the first entry because we can see that price has broken this structure here. Let's zoom in a little bit. Price has broken the structure right here, and we can also see a manipulation here, and this fair value gap here was being filled. The other one on the side here was just a, let me say, a fake imbalance, if I may say it in that way, but it doesn't matter. The naming doesn't matter as long if we understand price action. So from here, we can see that price moved to the upside, made a bearish candlestick, and then closed with a bullish candlestick. So that means this one here is not our entry. Let me show you clearly. If you have watched the previous video, you will understand what I am doing right here. We have a bearish candlestick, which is also a bearish engulfing candlestick, because this body is bigger than this one. But the falling candle is not a rejection candlestick. So that means there is no entry from this side. And we can also see that price is retesting this level here, this bearish candlesticks here. But then after this candlestick, we have another bearish engulfing candlestick. But right now, we can see that we have a rejection candlestick, which is this one here. So that means we can enter the market around this area for price to move to the upside, even though we have the fair value gap. But because we like to enter the market after, we can see clearly price broke this high with this move here, and also broke this low with this move here, and also price closed this fair value gap. So that means we have two manipulations in the market right now. We have two manipulations in the market. So anything in this area is just waiting for you to enter the market. You have to think of price in a different way so that you can understand the market a little bit better. So you enter the market with this candle close, and then you wait for the market to move to the upside, and then the market is moving to the upside. So let's find another example. Sometimes you will find this huge fair value gaps here in the market. And you know, if you see something like this, where we have a huge impulse and then a correction like this, most of the time, price is likely to come very, very, very close to this previous low and then move to the upside. Every time when you see this kind of trades, guys, you have to understand that they are very, very aggressive to the upside, because we have an impulse and then we have a correction. This will be your impulsive move here, and then we have a correction here. That's how you should understand. Sorry, I made a mistake. Impulsive move. So this is how you should understand how to make these entries here. But then if we look closely, guys, let's zoom in a little bit, you will understand it. We have a huge impulse here, we have a demand zone, and then we have this huge fair value gap from this area to here, and then price was closing this fair value gap slowly but slowly, and then it made this candlestick pattern. But we do not enter, because this is not where we should enter, because price is not even touching the demand zone. So that means we have to wait for the market to give us what we want. If the market doesn't give us what we want, that means we have to avoid that trade. But then the market shoot to the downside, move to the upside, and then suddenly we have a rejection candlestick to the downside. But this candlestick here, this is a bearish engulfing candlestick. Let me show you. The body of this candlestick is bigger than this one. If we put a line here, we can see only a slight different, and then followed by a rejection candlestick. So that means right now price is confirming everything that we need to trade this. So we will do something like this, and we make our target on the previous high. This kind of pattern here likes to touch this high here, so it will be something like this. It will move something like this, and we can clearly see that price is trying to move to the upside, and then suddenly we hit our target. But this is not a holy grail, guys. You will lose some trades, because sometimes the market can even if we understand the same thing, we don't approach the market in the same manner. I can show you this, and then me myself, I will lose a trade while you win the trade. It's possible. This is life. So let's move on to another example. We can see on the side, guys, this is where you should always confirm your trades, because you can see we have a fair value gap here. Let's do something like this. We have a fair value gap here. So that means you'll be waiting for the market to trade and come to this area. If you use a sell limit order here, that means you'll be doomed by this move here. And also another tip is that you already know how to trade this one here. I have made a video about it. So always, guys, I prefer to at least confirm your trades always. Here we can see that we have a fair value gap. Let's say we have a supply zone here. We'll be waiting for the market. Okay, it's already on the fair value gap, but price is not here. So moving forward, let's wait and see. You're waiting for the market to come to the zone, but price did not. What is happening? Yes, sometimes it's possible that the market might not give you what you want. So you just have to avoid those silly mistakes that most of traders do. If you miss a trade, you missed it. Don't try to chase the market, because the market will always try to bully you. So right now, let's look at the last example here. We have two fair value gaps and two supply zones here. We are waiting for the market to confirm on the first one, because we already know that sometimes the market might not even come to the last supply zone. So if we move forward a little bit, let's see. Okay, if you have entered the market with this bearish engulfing candlestick, and then you put a tight stop loss above this supply zone's high, that means you'll be stopped out. You will see why I am saying this, because I've seen a lot of people who put tight stop losses while their analysis are on point. Okay, you can see that the market is moving to the downside, but where is our entry? You have missed this one here. So where is the entry here, guys? Because we are looking for the market to move to the downside. That means right now, the same analysis that we made on the bullish trend, it should be vice versa. So right now we have a bullish engulfing candlestick and then followed by a rejection. So that means your entry will be on this candlestick close, and then you will wait for the market to shoot to the downside. That's how it is. So guys, I hope this video was very helpful. Please consider subscribing to the channel, and also check our Discord and then also our Telegram. See you on the next one.